There are commodities investors love to talk about: gold when uncertainty rises, copper when the global economy is accelerating, oil when geopolitics gets complicated, and lithium when the next technological revolution needs a new supply chain. What about the ones the world is demanding, yet no one ever really talks about? Ones like iron ore. It rarely commands the same attention. It doesn't have the speculative glamour of gold or the technological narrative around copper. Yet strip away the headlines and look at what the global economy actually needs to build, and iron ore becomes difficult to ignore. Welcome to The Market Knowledge. I'm Lyndsay Malchuk. Now, the reason iron ore matters is not simply that it becomes steel. It's that steel is one of the physical manifestations of economic ambition. Think about that. A country can't build a modern infrastructure network without it. Cities can't expand without it. Ports, railways, bridges, industrial facilities, energy infrastructure, and increasingly massive data centers all require steel. The financial markets can price growth expectations in milliseconds. The physical economy has a very different timeline, and before an investment becomes a new facility, a transmission line, a railway, or a data center, someone has to build it. And that requires an enormous amount of material. AI may be software driven, but the infrastructure supporting it requires land and power, transmission, cooling systems, buildings, and of course, steel. The same applies to electrification, infrastructure renewal, defense spending, and the broader push to rebuild domestic industrial capacity. So the story isn't simply about whether the world needs iron ore. It's about whether the world can secure the iron ore it needs from the jurisdictions it can rely on in the volumes and quality required, and then turn those resources into producing mines. That last part is where the resource story gets real. A deposit can be valuable and a resource estimate can look impressive. A feasibility study can demonstrate economic potential, but none of that produces a ton of iron ore. The real test is getting every piece from permitting to infrastructure to financing to construction, and ultimately getting a project into production at a scale that makes the economics work. And that's where a resource company moves from having something valuable in the ground to having something the market can actually value as a producing asset. That transition is anything but theoretical. Have you noticed that capital is being committed years before revenue begins? Well, it's a pretty straightforward reason. Infrastructure has to be available or built, permits have to be secured, construction has to stay on schedule, costs have to remain within a range the project can absorb. And throughout all of it, that commodity price that justified the investment in the first place, it'll move. Now, geological resource may be fixed, but the economics surrounding it are not. And that's one of the greatest challenges of resource development. It is also where the global iron ore market gets considerably more complicated. You see, for decades, investors could think about commodities primarily through supply and demand. China became an extraordinary force within the equation as its economy industrialized and its appetite for raw materials reshaped global commodity markets. But China's role wasn't simply that it consumed enormous quantities of iron ore. China changed the scale of the market. It created an extraordinary demand pull that encouraged producers around the world to invest in additional capacity, expand infrastructure, and optimize supply chains around a customer whose appetite seemed almost inexhaustible. That investment cycle helped create the iron ore market investors recognize today. Now, the question is what happens when that period of extraordinary Chinese demand matures and other jurisdictions hit the ground running. India is growing as an industrial economy, and that's just one. Infrastructure investment is continuing across multiple regions. Defense spending is increasing, data center construction is accelerating, and governments are increasingly focused on rebuilding domestic industrial capacity and securing strategic supply chains. But replacing one enormous source of demand with several emerging sources is not necessarily a simple substitution. Demand can fragment geographically, supply can remain concentrated, and the infrastructure required to connect the two doesn't appear overnight. That's why the supply side deserves a much bigger amount of attention as the demand story already has. Governments are becoming more concerned about where strategic industrial inputs originate. Trade policy is becoming more interventionist. Industrial policy is returning to the conversation, and countries are looking at domestic resource development as part of a broader strategy around national resilience and supply security. For iron ore, that changes the value of having reliable production in reliable jurisdictions. And not all iron ore is created equal. You see, the quality of the ore matters. So does the cost of processing it. So does its location relative to infrastructure and customers. And as steelmakers face increasing pressure to reduce emissions, the characteristics of the ore being processed can become increasingly important to the economics of steel production. That introduces another variable into that investment equation. And as the steel industry evolves, the market may increasingly reward certain types of supply over others. This is where Canada's iron ore story enters the conversation. Canada has the resources, but the investment opportunity is not created by putting a resource estimate on paper. It's created by getting that resource permitted, financed, built, and constructed to reach production. The ground may hold the value, but development creates the value, and that's a capital market story as much as it is a mining story. Capital still has to be deployed against a future market that nobody can know with certainty, and a project that looks compelling on paper at one point in the cycle can face a very different market by the time it is ready to produce. This brings us back to the bigger iron ore equation. The world is making enormous investments in physical infrastructure at the same time that the governments are becoming more deliberate about where the raw materials supporting that infrastructure come from. And when those two forces collide, the result could be a market where supply security becomes increasingly valuable precisely because new supply is so difficult and time-consuming to create it. And there is a very real possibility that the next decade of economic growth will be constrained not by a lack of capital, but by a lack of the physical materials, infrastructure, and production capacity required to turn that capital into reality. Iron ore sits directly inside that very equation. So the next time you hear about a massive AI data center, a new infrastructure program, a defense spending increase, or a government attempting to rebuild domestic industrial capacity, look past the headline for a moment. Think about what has to physically exist for that investment to become reality. Steel. And before there's steel, there's iron ore. Perhaps the commodity that rarely makes the headline deserves a much closer look. And that's exactly the conversation we're going to have on the next episode of the Markets and Leaders podcast as we sit down with Raul Goel from Century Global. I'm Lyndsay Malchuk, and this has been your Market Knowledge.